Thanks, Michael, and good evening, everybody. So the topic tonight, investment bankers and investment banking has taken a terrible beating over the past several years, and rightfully so in many ways. In fact, in some ways, the phrase itself, investment banker, is pretty toxic and has expanded effectively to encompass anyone or anything who is just sort of bad. So this is the latest investment banker on that front. This was curious to me. I've been a banker, investment banker, for over 30 years, and even though I have low levels of self-knowledge, it's never occurred to me that I'm inherently evil, or even marginally nasty. But who knows? So I think what I'd like to do this evening is deconstruct the true meaning of the phrase investment banking, what it has meant, what it means going forward. And I think also some definitions of around where the markets have taken it and what the overall sort of zeitgeist is around investment banking. My overall thesis, though, is that investment banking is an incredibly interesting and satisfying undertaking, that clients find value on both the market side and the corporate side in the fees they pay to the industry and to us. And properly defined has never been a destructive force in its proper fashion, although there's been plenty of rubble around the industry, obviously. And we'll see how the industry has changed and where we are now. I thought I might illustrate this to some extent via a path through my own career, together with a few rules and observations along the way. So the first rule, know what you're looking for. This is actually fairly important. In my very first job interview at the small liberal arts college in New England that I attended, two bright and aggressive young women asked me the question, "So, David, why First Boston?" And I thought, well, it's because I'm quite interested in learning about commercial banking, and I've always wanted to live in Boston, which is a lovely city. They then informed me that First Boston was, in fact, an investment bank based in New York. So that shortened the meeting to some extent. So I learned the first thing about banks. There are commercial banks and there are investment banks. You learn. At this point, I had to take whatever I could. So it was Irving Trust, which is at the time was a large Wall Street commercial bank. It eventually became the largest bank in the U.S. to be taken over via a hostile acquisition. So possibly one of the more poorly run institutions on Wall Street. But at least I was in the game. And I figured out pretty quickly that in those old days, there were two sorts of firms that dealt with corporate clients and the world at large. There were investment banks and there were commercial banks. Commercial banks funded themselves primarily through deposits and to some extent in the market, but really mostly by deposits, and lent out money. Investment banks didn't do any of that, basically acted as agents and did transactions in the capital markets. Now, Europe is always a little bit different, with a strong universal banking or blended banking component on generally smaller equity markets as well. But the U.S. was quite separate, as many of you will recall, with Depression-era regulation, Glass-Steagall, and some other regulatory pieces, strictly separating the two functions, commercial and investment banking. So in fact, it offers a fairly interesting way to define purely what is an investment bank, which back then was by statute and by regulation. I would define the following activities as sort of purely investment banking in definition. First of all, advisory-led, agency-based, and market-centric. These are the activities that define sort of a classic investment bank. And what do I mean? What do I mean by that? Advisory-led means that your clients find value in the knowledge and the advice that you give them, whether on the corporate side or on the market side, and that you somehow get paid for this. So examples of this are mergers and acquisition, structuring an equity transaction, structuring a bond transaction, equity research, fixed income research, and the like. And that this is effectively your leading source of value add and differentiation. Agency-based means that you're undertaking markets activities, dealing in securities, raising capital, all of these kinds of things as an agent. That is, you are matching buyers and sellers without taking a position or using cash capital to actually buy and hold debt and equity securities. And market-centric means just that your activities are basically involving the public equity markets, the public debt markets, to some extent the private markets as well. But you are a capital markets-based person in terms of your worldview, in terms of the kinds of advice you give to clients. Most importantly, investment banks back then were not principals. They did not invest their own capital in long-term assets. They did not invest their own capital in terms of lending, and they didn't take medium or long-term trading positions, especially in things that were illiquid. So my next career step was to get closer to the capital markets, which I did via joining a large Japanese bank to start its bond finance business. Still not a pure investment bank, but involved in the securities industries nonetheless. And I had a fantastic time there until I realized that, in fact, I was not Japanese. In 1984, this was a career limiter at Sumitomo Bank, which was a great place to work. But it took me 4 years to make the discovery that at that point in time, being not Japanese was probably a difficult thing. So clearly I needed to learn a little bit more and get some education. So I decided to procure an MBA. When I was in business school, I learned about universal banks, which are a kind of magical enterprise that combine the best of all possible worlds under one roof. This is sort of what universal banks do. And actually, all joking aside, this is a time when boundaries were beginning to blur. UBS, Goldman Sachs, JP Morgan, Bankers Trust, people were starting to push regulatory barriers. Clients wanted, they thought, one-stop shopping. And there were certainly profits to be made in one another's business. I stumbled upon this fact while interviewing with one of the major investment banks. I asked a very senior, these are all true stories. I asked a very senior partner the question, given the convergence in the business, how do you deal with the inherent conflict between your clients and your firm, which is acting as a principal many times, and what do clients think about that? And he carefully considered to that, and his response was that what he thought was that clearly I was not bright enough to work there. So once again, your star interviewer was kicked out onto the street, unemployed, but probably with the FBI investigating me for un-American activities. I then joined a smallish firm that financed growth companies and participated in the heyday of traditional investment banking, which was sort of the late 80s into the 90s and and sort of ending in 2001 when the tech bubble burst. This is a small selection of my deal loose sites. We had a great time taking companies public such as Microsoft, Starbucks, America Online. I learned a lot about operating under the traditional definition of investment banking. It was all knowledge-based. That's basically what we had. We didn't have a lot of capital, but we had a lot of research. We had a lot of advice, and we gave it to clients the right way. And if we were wrong, people punished us by not doing business with it anymore. It was actually quite self-policing. But seeds of change were in the air. First Boston, now partially owned by Credit Suisse, had invented two new types of debt securities, the high yield or junk bond, which to some extent expanded and also supplanted bank lending and gave people access to senior credit at a much lower credit standard, and the synthetic debt security, which basically institutionalized the funding of things like automobile loans or mortgages by putting those things into a pool and issuing bonds off of that pool. So, collateralized mortgage obligations have been around for 25 years, right? This was all very creative, actually, and everybody in the business immediately copied and improved these innovations. And a fairly large debt market grew around these kinds of securities. Ultimately, these bonds offered companies a more efficient and long-term source of debt capital. They offered people the opportunity, because their interest costs were lower, to buy houses and cars at cheaper rates. So in the early years, not such a bad thing. And this kicked off a huge surge in debt issuance that completely changed the landscape. You probably can't see this slide, but effectively the high yield market grew from about a $20 billion market to the current levels of $162 billion year to date as of a month or so ago. It's a massive liquid market. And obviously the collateralized debt obligation market has become even larger than that as people globally have used that to finance their world. So suddenly investment bankers needed to know how to access these markets for clients. They needed to know how to trade them and have the businesses to do that, which typically required a lot more capital than we had at the time as small players. There was also increasingly money to be made in investing side by side and lending and getting into the universal banking model that I picked up on earlier, that that was the beginnings of some fairly unsavory activity. But a lot of the mainstream equity capital raising and mergers and acquisitions were still done by relatively small firms, some of which were privately held. And so that began a great consolidation wave. And by the end of 2001, virtually every pure play investment bank of note had been acquired by a commercial bank. That's true, just as true in Europe as it was in the States. It was about a 4-year swing of consolidation. So, you know, it was an interesting time in the market. The commercial banks increasingly took larger and larger balance sheet bets on illiquid and risky assets that they didn't understand, while the investment banks fashioned ever more exotic securities to sell to the buy side and also to those banks. I don't know if you know the American comedian P.J. O'Rourke, but he once said that giving money and power to government is like giving whiskey and car keys to teenage boys. And so it was with the bankers, in a way. The few remaining larger investment banks started looking a lot more like wholesale commercial banks, with one crucial difference. They financed themselves in the markets rather than by deposits, and leverage ratios across the piece crept up. Commercial banks, on the other hand, didn't really know how to manage the risks in these fast-moving markets, and also generally the acquired investment bankers ended up running them anyway. So there was an element of reverse takeover by the investment banks to the commercial banks, who suddenly had very large balance sheets to play with a risk appetite to match. This did not end particularly well. So where does that bring us in terms of the current state of the investment banking industry? And several things have changed significantly that I'll go through in a second. I will say that during question and answer, we'll discuss the financial crisis, obviously, but my goal continues to be to define sort of what is investment banking, and I want to stay on that thought. There's a couple of different requirements now that I think do enter into the definition of what even a pure play investment bank needs to be. First of all, global capabilities are absolutely critical. One must have the ability to offer clients access to capital markets, whether debt or equity, around the planet. There are high degrees of differing levels of knowledge across these markets for different kinds of companies. London's always been a center for natural resources. It's the best place in the world to list an oil and gas company, whereas in the U.S., a lot of the technology and internet pieces have a very deep research following, and increasingly analysts and investors in all markets are willing to look across the globe for the most interesting ideas. Probably one of the most interesting examples of that is our Jefferies recent initial public offering of Manchester United, which we executed in the U.S. And putting the emotion of Man U aside for a minute, Man U is obviously an English football club. We took them public in a country that doesn't really understand professional football, and where professional football generally is an interesting but not massively followed sport. But U.S. investors do understand global brand marketing. U.S. investors do understand sports franchising, and those two pieces are the economic drivers of the company. It ended up, against a lot of headwinds and a lot of people telling us that it couldn't be done, a very successful transaction. And I think that's, you have to be global these days and have scale to do that. The second thing is the role of capital, which really has changed massively, even if you're acting in an agency capacity. Investment banks today need much higher level of capital to affect transactions, both in the primary and the secondary markets. In the primary markets, almost always we need to underwrite both debt and equity securities, and then re-offer those to the public via bonds or stock or what have you. And on the trading side, counterparties, people have got very large BlackRock, Fidelity, et cetera. They need to know that you've got the capital and the financial wherewithal to trade with them and to be an effective counterparty. Finally, not on the slide, but finally, regulators have definitely reasserted their authority. And the regulatory piece is huge and complex and a very interesting topic. But now we've got, I would say that regulators are dominant players in the industry today in many ways. Regulations such as Ball III, Dodd-Frank, Volcker Rule take us back to a previous era of regulation, for better or for worse, and try to see the future a little bit, but not entirely successful in my view. So what's an investment bank today? An investment bank today is the same thing as it ever was on some parts of the business. It's advisory-led, it's agency-based, it's market-centric, but it has to be global in outlook and execution. It is capital-intensive, albeit episodically. And so I think that the original definition holds in terms of role and behavior. The key driver is knowledge and advice based on that knowledge. And everything still flows from that, or everything should still flow from that. True investment banks are still primarily agents. The goal is to raise capital for clients in the capital markets. That's what the business is on that side of it. And while the role of capital to facilitate that has changed a lot, still the notion of not being a principal applies. And I can get into arguments with people about this in my business, but I think this is absolutely critical. No one, clients, regulators, shareholders, wants banks or investment banks to hold long-term illiquid positions that tie up balance sheet and create conflicts with clients. And this is still a very, this is a very big business. These are primarily the advisory businesses that I've been speaking to. And so you see, throughout the piece, this is a fairly long-term slide since 2008. So some pretty rough periods of time here in terms of corporate issuance and corporate activity. Not always the most robust of times, but generally you're seeing between a $40 and a $50 billion market in terms of fee pool. So this is still a great business, and you don't have to be a principal. You don't have to do some of the other things in order to have a very robust business around these markets. So I think, I guess the last thing I would say is that these businesses are in great shape, as I just said. But the one thing that we consistently hear from clients, again, they need and want advice on how to finance their companies, but they want their advisors to be unequivocally on their side of the table with no conflicts, although they need to be for them to be of sufficient scale to deliver their capital needs and be global enough to matter. Investors need to know that you're making markets fairly, that you're not trading against them, and that you have the financial wherewithal to close, as I said. Personally, I was there for all this, as I have been throughout the whole thing. My own firm got bought twice, and I ended up working for a big German bank, as Michael said. And I enjoyed spending my time at one of the fabled universal banks, being a bit of everything to everybody. And then I remembered what I actually like to do, which is to raise money for growth companies. And for the last 6 years in London, I've been working for Jefferies, which fits the above definition to a T, to do just that. Being in a boardroom, advising a client on how to finance a deal, grow it strategically, finance it in different markets, to me remains one of the most interesting and challenging things to do in business. And getting these deals done is challenging, it's tension-filled, and ultimately it's very fulfilling. On the other hand, you can't be in the seat if you're worried about how you're going to get back the 500 million pounds that you've lent the client. It's just a conflict. And in similar fashion, you can't trade with pension funds, mutual funds, or other investors if your overriding concern is how to dump all the toxic waste that you have on your balance sheet. Again, that's just a conflict as well. And manufacturing your own product is obviously fraught with moral hazard of all colors and stripes. So ask yourself one simple question: who stands to gain or lose the most from a trade? If it's you, then you should think hard about what business it is that you're in, but it's probably not investment banking the way that I'm defining it. Thanks for your attention here, and I hope you found these random thoughts useful and interesting, and I look forward to some questions and conversation.
Well, thank you very much, David. That really came from the heart. It was really quite fun, I think. I'm going to ask you a few questions that we've assembled from a variety of people in the audience, and I thought, while you get your breath back, I'll open with a sort of an easy one. You seem to learn a lot from failing interviews, but many of the folks in the audience, particularly a lot of the students who wrote in, would dream of succeeding in an investment bank interview. What sort of tips would you give them?
Look, I think it's a good question. I think that the people in the industry generally are quite intense, have a lot of passion. When I interview people, which I do constantly, it's probably what I do, what I spend I try to spend as much as I can either interviewing people or spending time with clients, right? Because both of those are the lifeblood of our business. I think passion, intensity have to be there. Intelligence is a given, and I think that the people who find their way to us typically are bright enough to make it happen, and secondly, actually want to be in the business. I think there has been, all joking aside, there has been a huge amount of negative publicity around banking and investment banking. And again, we've earned some of that, but that has had a winnowing effect. I think 10 years ago, everybody and their brother wanted to be an investment banker, and I think today, the people who actually want to do it are focused and bright, but I think that energy, that passion, that's what clients want, that's what we need as well.
Well, you mentioned, you opened with the reputation of investment banking, and obviously this is an interesting place here in London, where 2 years ago we had Occupy London, and "We Are the 99% was on everybody's lips. There's been a lot of talk as well about high income differentials among people, which have been shown in some cases to lead to alienation. So you have societies which have a high Gini coefficient, where there's a lot of dissension over that. But some people would argue it also applies within firms. Now, investment banks have got some very high differentials internally, as opposed to the partnerships, for example, that preceded them, at least where the equity partners would be balanced. And I'm kind of curious, because a lot of people here who think about things, I've got two from the Center for Study of Financial Innovation, who suggested that these high income differentials have helped shape investment banking culture. So are these rainmakers and traders, to use a talking heads phrase, psycho killers, qu'est-ce que c'est?
Right.
What do you think?
I think in many ways they are. I think that high relative income disparity can be just as toxic within a firm as it obviously is within the larger society, taken to its extreme. But it's also a reality of the industry, and there's obviously a massive amount of tension between pay for performance and overpaying for performance that's based on factors that individuals don't necessarily control. I think that the critical thing, in my view, is to control people from a management perspective, so they don't get themselves into trouble chasing money, which certain types of people just do in life. But from a cultural perspective, so I think there's a management challenge and problem that one has as a result of income disparities or potential income disparities across businesses. I also think that, and this is to some extent being addressed, I think, now in a lot of the regulatory debate about capping bonuses, about clawbacks and retention, and they're not quite sure, the regulators, what to do about this problem, but they have identified that compensation's a pretty key driver of it. And so those are all, it's quite confusing, I think, and not universal in terms of the way they're being applied, but those are all helpful tools actually for us as managers to keep people within the straight and narrow. But to directly answer your question, it can be quite corrosive to an internal culture to have that high degree of disparity.
That's really interesting to hear from somebody in your position.
Right, it is.
Well, you mentioned regulators, and in fact on your slide, they were sort of the sixth force in the world. The Talking Heads have an interesting song, "Don't Worry About the Government," and the lyrics go, "Some civil servants are just like my loved ones. They work so hard and they try to be strong." Why somebody wrote a song about civil servants, I don't know.
It's David Byrne, just,
That's
genius.
David. And we had a lot of questions about what did you think of regulators past, present, and particularly future. Where do you see this panning out?
Well, again, an interesting point and really crucial to the industry, I think. I won't profess to represent anyone's views other than my own here, because there's a lot of different views in our industry about regulators. I think that one of the key problems that regulators have is the lack of national and international policy around what governments and financial governments and treasuries want the banking system to look like and how they want investment bankers to act. And without that policy shell, I think the regulators are constantly on their back foot. And I've worked with regulators intensively, especially in my role at Jefferies, but to some extent at other parts of my career as well. And I think they are, the risk with a regulator always is that, and a regulatory agency, is that they are fighting the last war. as they say, in terms of their outlook, in terms of what they're trying to do, what activity they're trying to curtail. And in an age of ETFs and high-speed trading, they're worried about stuff that we fixed 5 or 6 years ago. And that notion of regulatory strength being more forward-looking and anticipatory, to me, is where the regulatory community needs to focus its energies. I think individual regulators are generally pretty good, although there are plenty of exceptions like there are everywhere in life.
When you talk about being anticipatory, could you give an example or two of how that might work?
Yeah, I think if you look at high-speed trading right now, there's no notion, and a couple of firms have almost put themselves out of business because they put in high-speed algorithms that have literally traded their capital to zero in about 3 hours. Incredible stuff. And the regulators have no response to that. There's no safety blocks in the market. There's no checks on individual firms. It's up to us not to go out of business, which is fine, and accept that as long as you're not taxpayer-backed effectively, which some of the larger places are. So that's one example that I can think of. The degree of regulatory arbitrage that still goes on around taxes is annoying. There are plenty of things to think about.
I mean, it's interesting to be talking to you today. I mean, it's basically 6 years since Bear Stearns, 5 years since Lehman Brothers, which was sort of celebrated earlier this week or last week. Those who are in the know when I chat to them talk, there's been huge changes. But I must say personally, from the outside, I haven't seen much. And I've seen a few crises keep rolling in. And we also have people like Nicholas Varone over at Bruegel. Nicholas has written quite a bit suggesting Europe's missed the boat on reform. And more recently, he said, just give up on international regulatory reform. These agreements will never come together. The talking heads would say, same as it ever was, same as it ever was. But do you see that regulators have materially changed?
Again, without overarching policy guidelines or direction, unfortunately, I think that it has not changed very much. And if I think about my portrait of Admiral General Aladdin, I will note that Bob Diamond, who firmly falls into that category, wrote an interesting article in today's FT that some of you may have seen. And it was very timely to today's thought, but Diamond was effectively decrying the lack of international cooperation and the continued asymmetry of banking regulations. All of them are well-meaning, but they're all doing different things. And if you look at even within Europe, if you look at the way that the FCA and the PRA are regulating us as a group, and if you look at the EU regulations, some of them are directly in contradiction, which is quite bizarre and difficult to deal with from a management perspective.
Could you pick a specific area?
Yeah, sure.
A
specific example is on compensation,
okay.
where always a volatile topic, right? But on the one hand, you've got regulators saying that they want pay for performance, and they want us to manage their cost base. On the other hand, there's EU regulation that is and clawbacks of compensation. All things I think are actually quite healthy, and things that we were doing at Jefferies years ago, which we got a lot of grief from our employees, as you might imagine. But the notion of holding back most of someone's compensation until you make sure that they've actually earned it and they haven't done something to blow the place up is not a bad thought. And that was the thought that actually that UK regulators had. Okay, these people are getting paid X and Y, irrespective of whether it's too much. Let's put some hooks into that. Let's have people let's make sure that they've done the right thing to earn that bonus. And so let's put retention time factors on it, 5 years, 10 years in some cases, and all the rest of it. Pretty interesting regulation. Still evolving, but it's in place now, has been for a couple of years. The EU comes out with a bonus cap, which is a populist thing and sounds great until you realize that people are going to get paid anyway, one way or another. They're going to increase their salaries, which has happened across the board. And so suddenly you're actually, by doing that, you're actually increasing the amount of money that people take home now with no hooks into it. And it reduces your ability as a manager to forward manage their performance based on what they did a couple of years ago. So those two, that's a great example just in my mind, because those two regulations are directly contradictory, and one's an EU regulation, and one is, one is an FCA regulation, PRA regulation.
Okay. I'd like to just cover a couple of questions about the future of investment banking. But before we start, it might just be helpful if you explain, because Jefferies has been through an interesting transition in ownership that I think a few people wouldn't mind just hearing from your lips.
Right. And actually, again, sort of illustrative of what's gone on in the industry. So Jefferies was an independent firm for many years. The firm celebrated its 50th birthday about a year ago. Started off as an equity-only brokerage firm on the institutional side. We really don't do retail businesses. And after all the acquisition of all the firms, which really did happen, and the last one to get bought was Donaldson, Lufkin, and Generette in 2001, which was bought by Credit Suisse. Pretty much all of the independent investment banks have been acquired, and that's true here in the city as well. Probably 50 or 60 firms got bought between 97 and 2001. It was a pretty short period of time. Oddly enough, my firm, Alex Brown, was the first firm to get bought. We got bought by Bankers Trust and then by Deutsche. In any event, Jefferies, our CEO, seeing all that happen and realizing that there was a pretty big hole in the market for mid-cap and growth companies, decided to start hiring corporate finance people and move into that part of the market, which we did. So fast forward 10 years or so, we are the fastest growing pure play investment bank in the world. We have a fairly rapidly growing business. We had purchased a firm called Baish, which is basically a futures and commodities broker. And the rationale I won't bore you with, but it was an interesting acquisition at an interesting time in the market. Unfortunately, about 3 months after we bought it, a firm called MF Global made one very large, very wrong trade and effectively went out of business in about 2 weeks. MF Global's business was quite a bit like, to some extent, the business that we had just acquired. Plus, there wasn't anybody else in the market with our market cap. So we suddenly became the focus of a massive amount of attention in terms of our business model and whether or not we could survive. Slightly to our surprise, but there it is. That's what happens in the market. At the same time, a research analyst wrote a report from a very tiny firm, from a tiny ratings agency firm, wrote a report on this that was, he said that we had $8 billion of Italian government debt, which was true. We were also $8 billion short Italian debt. So we were a primary dealer in most of these markets, and people run long short positions. And net, we were actually slightly short. But he didn't write about the short side. He just wrote about the long side. And so people were horrified. And we disclosed everything to the market, down to the CUSIP level of the securities, which horrified our traders. But as Rich Handler, our CEO, said, I'd rather be naked than dead. And so we weathered that pretty well over the course of about 3 weeks, although it was a very interesting moment, as you can imagine. About a year later, and I guess about a year ago now, we merged with a firm called Leucadia. Leucadia is a firm that we've known for a long time. They were investors in Jefferies in different parts of Jefferies for about I guess 12 years or so. And our CEO is now the CEO of the combined company. So it was a true merger. But importantly, I think in terms of investment banking and the definition thereof, being an independent broker dealer it can be a tricky thing. And we thought we needed more stability, and so we merged with Leucadia. They're a little bit bigger than us, but the combined thing is about $10 billion in market cap, which is quite small actually for a financial institution, but big enough to keep the wolves at bay, as it were.
Okay. Well, with that background and ending quite nicely on the role of the broker-dealer, a fellow professor reminded me actually of a great book. Those of you who might be interested in picking up and learning more about the topic of investment banking, Morrison and Wilhelm wrote a great book, Investment Banking, Institution, Politics, and Law, back in 2007. Now, in that book, they argued, and I quote here, investment banking became necessary because the informational demands of the capital markets were too complex to be met through the type of arm's length contracting that the courts can enforce. So it was this whole notion of huge, small markets of trust, if you know. It was just immense amounts of trust that I knew you were there. Now, you were emphatic that you couldn't be a principal in a market like that. You had to be a true agency, and I think they'd agree with you. However, they went on to predict that the future will see sort of highly capitalized full-service investment banks facing off against effectively relationship-based boutiques. Do you have any views on that as sort of the evolution of investment banking?
Well, it's a very interesting question also, and I think that the answer depends to some extent on the size of the client company. Really large companies, if you know, France Telecom or a company of that size, a very large company will completely disaggregate their services, what they buy. They'll do, you know, they'll have their banks for lending, they'll have their investment banks for capital markets activities, and they'll have the best possible human to do M&A advice that has the relationship set. Whether that person works doesn't really matter. A lot of the large UK corporates are highly evolved in this way. They have corporate brokers, they have financial advisors, Rule 3 advisors. I mean, the UK, it's actually not a bad model for the way people will procure investment banking services. So, to answer your question, the larger companies, I think, will buy from a disaggregated group of companies. I think that the mid-cap, which I would define as sort of between 500 to 5 billion, pick your currency, doesn't really matter. Between 500 to 5 billion, that postal code of companies will continue to look for investment bankers that have the kinds of things that I enumerated. Okay. Boutique advisory firms are interesting animals, and I think provide a lot of good service. Some very good people have gone to boutiques. But if you've got a client whose deal is contingent on getting financing in the markets, which many transactions are, especially in the medium size, where you really do need to raise, you know, 300 or 400 million sterling to get your transaction done, you've got to have an advisor who's got a view on those markets, where your debt's going to price, where your equity can get done, whether it's a rights issue or an accelerated book build. And that has to be the same firm, unless you want to open the doors to other firms coming in what is always a confidential M&A situation. And I'm just talking about M&A driven capital activity, but a lot of it is, especially in mid-cap land. And as soon as you start broadening the circle, you risk disclosing what your plans are, and so you got all sorts of problems. So anyway, I think that there's a future for integrated investment banks on my definition for those medium-sized to largish medium-sized companies. Smaller companies, you know, that take what they get wherever they can get it, and I think larger companies will continue to be even more highly disaggregated.
And how do you see that squaring off against kind of the Continental universal bank model? Where do you see that fitting into this?
You know, the universal banking model, to me, has never made a huge amount of sense. I mean, really, because asset management is a totally different part of the business. And people think that there's a lot of synergies between asset management and the rest of the industry, but it's not true. And I think that's been true for a long time. It was very difficult when I was at Deutsche, and it should have been very difficult, but it was very difficult when I was at Deutsche selling product into our retail system, because they said, well, you know, you're in-house, so you have an even higher standard of performance than somebody coming in externally for all the optical and compliance reasons. I think lending can be important, but consumer banking and retail banking, I mean, there's no synergy there at all, unless you're a big universal bank and you're funding yourself with a 2% deposit rate, which is a great thing from a financial perspective for those businesses. You know, I don't know what everybody gets on their current accounts these days, but mine's pretty close to zero, and has been forever, right, for the last 7 or 8 years.
And that's before inflation.
And that's, well, no, I mean, that's exactly right. So I think, again, the universal banking model certainly economically benefits those institutions by giving them a massive funding base for very low cost.
Okay. Well, actually, I'll use that opportunity to turn to a couple of questions. We had a regulator and an accountant both asking about quantitative easing. So the questions that they had were broadly along the lines of, they see quantitative easing as creating money, which is simply being used to bolster banks' balance sheets. You know, if we took QE to its logical conclusion, the so-called Bernanke law, money supply shall expand so as to fill the balance sheets available for their depletion. Why not take QE the whole way? You know, that is, eliminate banking leverage totally, and let the money supply be the sole source of credit.
It's you know, it's an interesting thought, albeit a highly theoretical one. So I think that the debate around QE continues. You know, we all saw the markets move today pretty significantly in response to Summers' withdrawal from the race to be a Fed chairman. He was a hawk, So that was going to do all kinds of nasty things to quantitative easing, and now it turns out he's not. So QE has been, it's hard to answer the theoretical question because the credit markets to me are infinitely deep and actually interesting. And so in terms of, if you follow that argument to its logical conclusion, who's the arbiter, who's the gatekeeper? And I go back to my P.G. O'Rourke quote, if there's that much liquidity, you're going to have a lot of whiskey and car keys going on somewhere.
Good. Just returning to the future of kind of banking in general and the universal banking bit. Last week, the FT reported the CEO of Citadel, Ken Griffin. He was saying, and I quote again, "The span of control is inconceivable. How does the head of XYZ universal bank track retail banking globally, a securities business globally, an asset management business globally?" And this echoes a recurring theme we've had at long finance events, that too big to fail is too big to regulate. Do you think that it's just a question of size, or largely a question of size?
I think it's a question of size and complexity. And if you're involved in that many businesses, in that many jurisdictions, I really believe that it is too big to regulate, and certainly too big to fail. And the constant theme to many of your questions that we're fielding here tonight is what has changed, what's different, where are we now, and what's the response of the regulators been? And there hasn't been that much change in terms of the actual function of these really large places. In fact, perverse consequences, right? I mean, the larger banks have become larger. They're all quite a bit larger now in terms of market share of some of these primary and secondary markets than they were in 2007 when there were more competitors. And these institutions have benefited massively by having people go out of the market effectively. So I think it's quite challenging. And again, I've spoken my view on the synergies of universal banking, which I think accrue to the favor of the universal banks, but it's not clear that there's a client benefit. And so I don't. On the other hand, there's not been a countervailing pressure. But the J.P. Morgan thing is such an interesting story if you followed that, and then now there's criminal indictments, and so which I think is interesting. But basically, J.P. Morgan was required to keep about $60 billion in cash and short-term securities because of their requirements to have a buffer by the regulators. This is internal money. And so what happened there is that you can just, I'm making this up a little bit now, but you can just sense that what happened there is that the people inside JP Morgan got bored at making 0% on there, and they decided to play around just a little bit in terms of risk and push that risk envelope just a little bit. Well, you can't push around $62 billion a little bit. You are the market. It's sort of like Brownian motion. You can't enter into a market with that much capital without becoming the market. And that's what happened. And they were right for a while. Mm-hmm. They made $6 or $7 billion in one year, and then the next year they lost it. But when they lost it, it was a big headline and all very tragic. But that's just too big. Yeah. So don't get it.
Well, speaking of sort of some of these scandals, I mean, one of the things that we've often come across is that you see a lot of these systemic failures correlate well with lack of competition, for example, in audit, credit ratings, U.S. mortgage insurance, where there were really a handful of players in that, or retail banking in the UK, where we're very concentrated. And we also continue to see a lot more cartels being exposed. Last year it was LIBOR, this year it's aluminium. Do you have any thoughts on where more openness and competition might be needed? What are the bad markets that need a bit of reform?
Lots of issues inherent or buried in that question. I think. Let me first address the issue of the infrastructure required to support these markets, which is regulatory people and structures, insurance, credit ratings agencies. If you think about the explosion in the magnitude and the complexity of especially the debt capital markets over the last, it really has been about the last 15 years or so since these new kinds of securities came onto the market. Those markets have absolutely exploded. The number of issues, the type of issues, the complexity of it, very complicated securities. And much has been written about the bad ones, but plenty of good ones too that make it easier for all of us to do things. But still, much bigger. The growth on the ratings agency side, the growth on the bond, nothing. I mean, so you've got a market that has greatly outgrown its support structure, and has created, you know, a duopoly, you know, whatever part of that structure you talk about. But there's basically 3 ratings agencies that are respected globally, and there's there's very limited competition there. It's the same thing for bond insurance, which, you know, was exposed for what it is in the last cycle. But so I think the growth of those lowercase regulatory pieces to those markets that actually give people which give people a sense for what they're investing in, I think that has damaged the market. I think the cartel-like behavior is something different. I mean, to me, the LIBOR thing was absolutely disgusting. That was, to me, that was a real low point. And I think that it was such a simple thing. I mean, I'd never even thought about LIBOR rigging because it's LIBOR, right? But apparently, not apparently, but that's not right. So I think that kind of behavior needs to be regulated out of existence, and that's not hard to do. Those, you know, the people who are involved are just bad people, and there should be real consequences for that.
Okay. Let me see if I could squeeze in just a couple more questions. One was, you're in kind of a very interesting position because you can contrast London and New York, and in our Global Financial Centers Index, London and New York seem to keep retaining those top spots, no matter that some of the Asian centers have been rising to meet them. But a number of commentators are always afraid, whether it's LIBOR or the U.S. Foreign Account Tax Compliance Act, FATCA. A lot of people feel that the U.S. has it in for London. A lot of people would say that no, London and New York are very strong. A lot would say we're has-beens. You know, are we in London, to use David Byrne again, burning down the house, or in the case of regulation, fighting fire with fire?
Well, I think that certainly the regulatory regime here has gotten much tougher than most places on the planet, if not anywhere else on the planet. And so I think that's probably not a bad thing, given all of the you know, some of the things that have happened over the last decade. On the same token, though, it's again, you need symmetry and regulation across borders. I think in terms of the competitiveness on a relative basis, and whether New York has it in for London or vice versa, those are great headlines to write. Those are great stories to write. It's a huge amount of fun. And you know, the evil Americans, or the insane Brits, and all the crises have sprung from there, or they've sprung from here. I think the reality is, and I've spent 15 years in both markets, I think the reality is that we've got a lot more in common with New York than against it. I certainly don't think that there's any conspiracy theory against London, because if you've met any New Yorkers, they just don't care. New York is the center of the world anyway, right? And as a Midwesterner, I can say that. So I think that's a bit overblown, but I do think that the question as to the future of financial centers is an interesting one, and you have to parse the industries. The trading business, the asset management business, the secondary market components of everything that we do are primarily, well, they're where they want to be. And if Edinburgh is a huge asset management center because Edinburgh is a nice place to live. There's a lot of managed money in Denver. There's a lot of managed money in La Jolla. There's a lot of managed money in Switzerland. So if you've got a few $1 billion to invest, you can live wherever the hell you want, and people will find out where you are and probably trade with you electronically. And a lot of it is electronic, and that's not a bad thing. I think in terms of primary capital markets, in terms of corporates, taking M&A advice, corporates talking to their shareholders, London being the best example I can think of in my whole career for that. I mean, this is a tiny town, right? You can go see most of your major shareholders in the course of a morning, and there's huge benefit to that small network effect. And so I think that London continues, and New York to the same extent, London continues to have that structural advantage of just everybody being here. And the people try to ruin that, whether it's traffic or whatever. But ultimately, I think places like London and New York are fairly special and will retain, for that part of the business, their preeminence unless we mess it up.
So I'll see a lot of CFOs getting on their corporate Boris bikes and visiting their shareholders.
Absolutely.
Well, just before I end on a personal note, I'm curious if you could spend a minute or two just on what are the most, looking across banking in general, and obviously with your emphasis on investment banking, but what are some of the most exciting things you see ahead? From a consumer perspective, we hear about Bitcoin. We're supposed to see some UK challenger banks. We've got massive new apps on our phones. There's social media banking. If you had to look out there, what do you see as interesting challenges on the horizon?
Yeah, I think here in the UK, the most interesting thing I see is within consumer banking. I think that you talk about cartels, right? I mean, there's only a handful of high street consumer banks in the UK, and I think that UK consumers are overcharged and underserviced. And I do think that combination of challenger banks, like Metro Bank, challenger structures like online banking, will really change the status quo and make our lives better, faster, cheaper, right? I mean, I think that's important. I think that's going to change the economics of that piece, and that's quite exciting. I think this notion. I spoke earlier about investment banking and how the market is tiered in terms of who gets what kinds of service. Small companies have a tough time. In this case, I mean really small companies, SMEs, have a tough time getting financing because it's below the radar screen of anybody that we deal with, and we're growth people. But if you need to get £5 million, that's a pretty tall order. The peer-to-peer lending and peer-to-peer investing on the web is still in its infancy, but a fascinating thing. And I think that and some noses will be bloodied and people will lose money, and so the regulators will, rightfully think what they need to do. But ultimately, that market, I think, is very interesting in terms of getting capital to the people who are actually, hiring 20 people and, putting up an extra chain of shops or building a small factory and, getting those. And so peer-to-peer funding, debt funding, equity funding is, I think, a fascinating piece of the world.
Well, that's good. We have the chief executive of Zopa, Giles Andrews, here in the front row, so he liked that plug. I could see him smiling. Right. Well, just if I could end on one final question, sort of a personal note. I opened with a bunch of students, and then we had a whole raft of journalists, analysts asking all these other questions, but I'm going to end on students. We had a number of sixth formers. And I think they do seem to get the lifestyle bit. And they asked sort of, what have you achieved once in a lifetime as an investment banker? What do you regret? What does the future hold for David Weaver in 5 years' time? And will Tracy still be your beautiful wife?
Gosh, those are all very big questions. I'll let my wife speak for herself. But I've been incredibly lucky and fortunate. I've been a banker during a really exciting time during the growth and evolution of the markets. I was mainly a tech banker, a software guy for 15 years, and I just had a blast financing those companies. It was a real hoot. And I think there are some giants like America Online that I took public that would have done just fine without me. I like to think that I helped a little bit to get them public. But there are also a few dozen companies that I can look to and say that they probably wouldn't have been successful or might not have been as successful without, maybe a little bit the advice that my teams were able to give them over the years. And there's a lot of satisfaction to that. When you take someone public, they either love you for the rest of their life, or they don't. And it's pretty much binary. People that I took public 20 years ago still, when they're in London, buy me a beer. So that's been an immense, and again, I've been very fortunate to be in that part of the market. That was immensely satisfying, as has, training up people, all the things you do in business, training up people, mentoring people, helping people, some of our younger guys grow into some of the best bankers and investors of their generation, a half a step behind me. And then finally, I would say that the Jefferies has been fascinating and very satisfying. I moved to the firm in May of 2007, if you can imagine. So the world was just about to go to hell. And we've been very fortunate in our timing. I've been fortunate enough to have a management team in New York that's been supporting us through that. But when I joined, we employed 150 people in Europe. We now have about 1,000 people in Europe. So we've driven a lot of job creation. Jefferies is a difficult but interesting place to work. There's a lot of intensity and passion and not a lot of management stuff. So that's the kind of environment some of us like to live in. In terms of regrets, I just have no regrets. I've made a huge amount of mistakes, but you know that is what it is.
So we moved from David Byrne to Edith Piaf.
Yeah, but I regret that. That's precisely right. And I'm very fortunate to actually, in fact, have a beautiful wife. So that's a good thing for me and a lucky thing for me.
David, it's been really nice. I enjoyed your presentation. It's been a delight to have you up here with your candor and humor. So thank you very much for coming and sharing. Could I ask Professor Doug McWilliams, who said, if you don't mind sitting, would just like to say a few words by way of closing. Doug.
Well, I'm the very lucky gentleman who has the splendid duty of proposing the vote of thanks. David, you told us about some interviews that you had failed, but I think to get where you are, you must have passed one or two interviews as well. And I think this evening you've passed yet another interview and done it absolutely brilliantly. So can you please show your thanks in the traditional way? Thank David Wiebe. Thank you very much indeed.